Welcome to Module 3 of the CSS Pension Plan's online version of its Retirement Income Options, or RIO workshop. My name is Rhonda Rode. I'm one of the pension plan consultants with the CSS Pension Plan. Besides myself, Fiona May, another one of the pension plan consultants for the CSS Pension Plan, will also be delivering this module of the online RIO workshop. In Module 1, we covered the first leg of the three-legged retirement income stool, Canada Pension Plan, or CPP, and Old Age Security, or OAS, and in Module 2, we covered the second leg, personal savings products. In this module, we'll cover the third leg of the three-legged stool, which is comprised of workplace pension plans for those of us in Canada fortunate to work or have worked for employers that provide one, like our own CSS Pension Plan. Currently, only about 40% of Canadians belong to a workplace pension plan, so we are very fortunate to belong to one. This is the Saskatchewan version of Module 3. We have separate Module 3s for BC, Alberta, Manitoba, Ontario, and Federal, depending on which jurisdiction governs your pension funds in the CSS Pension Plan. There are exceptions, but generally speaking, if you are currently working for an employer member of the plan in Saskatchewan, or last contributed to the CSS Pension Plan while working for an employer member in Saskatchewan, your pension funds are subject to Saskatchewan's pension legislation, and this module applies to you. If you are not sure, you can check your annual statement to see which jurisdiction governs your pension funds. In this module, we'll start by looking at your account in the CSS Pension Plan. The principal purpose of the CSS Pension Plan is to provide you with a retirement income with the funds you have accumulated in the pension plan. Your pension funds are a combination of contributions you have made, plus contributions your participating employer has made on your behalf, and accumulated investment earnings thereon. The CSS Pension Plan is a defined contribution pension plan, or sometimes referred to as a money purchase pension plan. So the more pension funds you accumulate in the plan, the more will be your retirement income. The factors that will determine how much you accumulate in the plan are the amount you and your employer contribute or have contributed to the plan, the rate of return on those contributions, and how long the contributions are invested. Generally, your account balance grows over time, so delaying your retirement tends to increase your retirement income. Early retirement under the CSS Pension Plan is age 50, or can be earlier than that if your age plus years working service equals 75 or more before you turn age 50. Check your annual statement for your early retirement age, or you can delay the start of your retirement income with your CSS Pension Plan funds up until the end of the year you reach age 71. As registered pension plan, or RPP, that is a defined contribution pension plan, the Canada Revenue Agency sets a limit on how much can be contributed to the CSS Pension Plan. If you are an active member, someone who is currently working for an employer member and contributing to the plan, the maximum you and your employer can contribute combined in 2020 is the lesser of 18% of your current year's employment earnings and $27,830. If you and your employer are not contributing up to your contribution limit, you can make extra or additional voluntary contributions to take you up to your limit if you wish. You would arrange this through your employer's payroll department so that the extra contributions are deducted off your paycheck and remitted to the pension plan each pay period. If you decide to make additional voluntary contributions, you can turn them off and on whenever you like, but you cannot access them until you are no longer working for any employer member of the CSS Pension Plan. Please keep in mind that your contribution to the pension plan is separate from your RSP contribution limit, and you cannot use your RSP contribution room to make extra contributions to the pension plan. Also, if you do not contribute the maximum to the pension plan in any 1 year, the unused room is not lost. It will become part of your RSP room in the following year. Your contributions to the plan are tax deductible, so that saves you income tax. If you are an inactive member of the plan, which is someone who has funds in the plan but is no longer contributing because they aren't working for an employer member anymore, you can contribute to an RSP and then transfer that RSP to the CSS Pension Plan, along with any other RSPs you may have. Please contact one of our pension plan consultants if you wish for more information on this. You must convert your funds in the plan to a retirement income sometime before the end of the year you reach age 71. The retirement income you receive from your pension funds is fully taxable. Most of the funds, if not all the funds in your account, are locked-in funds. According to pension legislation, locked-in funds must be used to provide retirement income. The amount of your locked-in funds is shown on your annual statement. The options for a retirement income from the CSS Pension Plan are a traditional monthly pension, which is an annuity type payment, or our variable benefit payment option. If you wish, you can transfer your pension funds out of the plan and receive an annuity from an insurance company, or a prescribed RIF or PRIF from a financial institution. We will explain the above options in more details a little later. If you have any non-locked-in funds in your account, it will likely be because you made or are making additional voluntary contributions. Non-locked-in funds are only available to you once you are no longer working for any employer member of the pension plan. You can access them as a lump sum, subject to income tax, or as a transfer to an RSP with a credit union or other financial institution. Or if you are retiring, you can use them for a retirement income, such as our monthly pension or VB payment from the pension plan, or transfer them out to get an annuity from an insurance company or a RIF from a credit union or other financial institution. What happens to your pension funds when you pass away? There's two possible situations. You either pass away before you convert your pension funds to a retirement income, or you pass away after you convert your pension funds to a retirement income. If you pass away before retirement, your surviving spouse has first claim to your pension funds, regardless of what your designation of beneficiary form or will might say. This is in accordance with pension legislation. In Saskatchewan, pension legislation defines spouse as someone to whom you are married, or if you are not married, someone with whom you are living common law for at least 1 year. Your surviving spouse can leave the funds in the plan until further notice and receive the same return as all other members, start a retirement income with the funds at any age, withdraw the funds as a taxable lump sum, or transfer the funds out to a credit union or other financial institution. If there is no surviving spouse, or your spouse has signed a prescribed form waiving their rights to the first claim on your pension funds, then your pension funds would be payable to your designated beneficiaries or estate as a taxable lump sum. If you pass away in retirement, the survivor benefits depend on which retirement income option or options you selected. We will go through the survivor benefits when we discuss each of the retirement income options. The CSS Pension Plan is one of the oldest defined contribution pension plans in Canada, and one of the few that offers its own internal retirement income options. In other words, with the CSS Pension Plan, you don't have to transfer your pension funds out of the plan at retirement. You can if you want, but you don't have to. Members of many other defined contribution plans must transfer their funds out at retirement, but not so with the CSS Pension Plan. The first option we are going to look at is the traditional monthly pension, or the annuity type payment. You can convert some or all of your non-locked-in funds and your locked-in funds into a pension. The pension option will provide you with a fixed monthly income for your lifetime. It is important to keep in mind that once you start a monthly pension, you cannot make any changes to it. It is set for life. The CSS Pension Plan has been offering its own monthly pensions since 1972. When you start a monthly pension, your pension funds are removed from your account and put into the pensions fund. And it's from this fund you receive your monthly pension payment for as long as you live. With the pension option, you don't have to worry about making investment decisions in retirement, nor worry about outliving your pension funds. The amount of your monthly pension payment is based on 3 factors. The first one being how much pension funds you have. The more pension funds you have, the more will be your monthly pension. The second one being the long-term interest rates that are in effect when your pension starts. The higher long-term interest rates, the higher will be your monthly pension. We refer to this long-term interest rate factor as the annuity rate, or sometimes the pension conversion rate. And the third factor is your age, or how close you are to average life expectancy, which is about 82 to 83 years of age. The older you are when you start your pension, the higher will be your monthly pension payment. The first monthly pension option is the single life pension. A single life pension will only provide a lifetime pension to you. It does not provide a lifetime pension to your surviving spouse if you have a spouse. Single life pensions can have guarantee periods of 0 years or no guarantee, 10 years or 15 years. The longer the guarantee period, the lower your monthly pension payment will be. A single life pension guaranteed 0 years or with no guarantee will provide a lifetime pension to you for as long as you live. However, once you pass away, the pension stops. In other words, the pension dies with you. A single life pension guaranteed 10 years or 15 years will provide a lifetime pension to you for as long as you live. But it is guaranteed to be paid for at least 10 or 15 years depending upon your choice. If you pass away before the guarantee period expires, your pension will continue to be paid to your beneficiaries or estate for the balance of the guarantee period. If you outlive the guarantee period, you still get the pension for your life, but there would be no payments to your beneficiaries or estate upon your death. Assume, for example, that you select a single life pension with a 15-year guarantee period. In our example, that would be $399.42 per month. You would receive this amount for as long as you live. If you were to pass away 7 years after your pension starts, the monthly pension of $399.42 would continue to be paid to your beneficiaries or estate for 8 years, until the 15-year guarantee period expires, and then the pension would stop. However, if you are still alive when the 15-year guarantee period expires, you would still get the $399.42 for the rest of your life, but there would be no survivor benefits upon your death. Our next pension option is the joint and last survivor pension. A joint and last survivor pension will provide a lifetime pension to you, and after your death, your surviving spouse will receive a lifetime pension as well. Joint pensions pay less than single life pensions because they cover 2 lives, yours and your spouse's. Joint and last survivor pensions can be guaranteed for 10 years or 15 years. If both you and your spouse die before your selected guarantee period expires, the pension will continue to be paid to your beneficiaries or estate for the balance of the guarantee period. The longer the guarantee period, the lower the monthly pension. Suppose, for example, that you select a 15-year guarantee period and both you and your spouse pass away after 6 years after your pension starts. In that case, the full monthly pension would continue to your beneficiaries or estate for 9 years, then the pension would stop. With a joint and last survivor pension, there are also different spousal benefit percentages to choose from. The amount of the pension that your surviving spouse receives after the guarantee period is over. The spousal benefit percentages are 60%, 75%, and 100%. For example, assume that you and your spouse select a joint and last survivor pension, guaranteed 15 years, with a 75% spousal benefit level. So in our example, you'll receive $360.71 monthly for the rest of your life. If you die before the 15-year guarantee period is over, your surviving spouse would receive the full $360 monthly for the balance of the 15-year guarantee period, and then they would receive 75% of the $360 for the rest of their life. If you die after the 15-year guarantee period is over, your surviving spouse would immediately receive 75% of the $360 for the rest of their lifetime. Once the guarantee is over and both you and your spouse have passed away, the pension stops. Note that if you and your spouse select the 100% spousal benefit level, your spouse will receive 100% of the monthly pension for the rest of their lifetime, regardless of when the guarantee period ends. The third pension option is the prescribed pension. The prescribed pension is a type of joint and loss survivor pension that is prescribed by pension legislation for members who have a spouse when setting up a retirement income. You will receive a pension for your lifetime, and upon your death, your surviving spouse will receive 60% of your pension for the rest of their lifetime. In our example, you would receive $372.61 monthly for as long as you live, and upon your death, your surviving spouse would receive 60% of the $372 monthly for their lifetime. There is no guarantee period under the prescribed pension, so there are no survivor benefits to your beneficiaries or estate once both you and your spouse have passed away. The other retirement income option available from the CSS Pension Plan is the variable benefit or VB payments option. As we'll see, variable benefit payments are not at all like a monthly pension. VB payments is a relatively new option. It has been available since 2006. VB payments are simply periodic withdrawals from your CSS Pension Plan account. The withdrawals can be set up as monthly or annually. VB payments are not at all like a monthly pension. In other words, VB payments will not guarantee you a fixed monthly payment for as long as you live. With VB payments, you set the amount of your payments, and you can change your payments from time to time if you want. The payments can be $500 a month, $1,000 a month, $5,000 a month, or whatever amount you want. However, the faster you spend the funds in your account, the less time your money is going to last. Because the pension funds remain in your account, you are still responsible for deciding on how those funds are to be invested among the plan's 4 investment fund options. These are the same investment funds options that are available to you today. Also, just as is the case today, if you like, one of the CSS Pension Plan consultants can assist you with these investment decisions. In accordance with Income Tax Act regulations, there is a minimum annual withdrawal for VV payments, but it doesn't start until the year you turn 72. So until that time, minimum annual withdrawals are 0. The minimum withdrawal percentage increases each year as you get older. If you have a spouse and he or she is younger than you, you can have the minimum withdrawal percentage based on their age, which would then make the minimum payment calculation less than if it was based on your own age. There is no maximum withdrawal limit for pension funds governed by Saskatchewan pension legislation. Since there are no maximum withdrawal restrictions, you can spend your Saskatchewan pension funds as quickly as you like. You can specify any amount for your withdrawal, or spend the funds over a certain number of years, and also have the flexibility to make lump sum withdrawals. With VB payments, you can temporarily stop your withdrawals if you want, up until the end of the year you turn 71. As already mentioned, you can also change the amount of your VB withdrawal. For example, you might want higher VB payments in your early years of retirement and somewhat lower withdrawals later on. You also have the option to convert all or a portion of your pension funds to the traditional monthly pension option if you wish. We do have some of our members that start with the VB option for the flexibility and potential growth when they first retire and then convert to a monthly pension later on when the guaranteed is preferred and the annuity rates are more favorable. This is the minimum withdrawal percentage chart set by the Income Tax Act for VB payments and withdrawals from RIFs and PRIFs available from credit unions and other financial institutions. As already mentioned, the minimum annual withdrawal for VB payments from the CSS Pension Plan does not start until you reach age 72. However, the minimum withdrawal from RIFs and PRIFs with a financial institution starts in the second year that you set up the account. With VB payments, whatever funds remain in your account upon your death will go to your heirs. Your surviving spouse has first claim to your funds upon your death. The pension funds roll over tax-free as a lump sum to your surviving spouse, and then he or she receives VB payment withdrawals at whatever amount they wish, which are taxable to your surviving spouse in the year received. If you don't have a surviving spouse, or your spouse has signed a form to waive their right or first claim status to your funds, then any remaining funds upon your death are paid to your beneficiaries or estate as a taxable lump sum. If leaving any unspent pension funds to your heirs is important to you, the VB payment option certainly addresses that issue for you. As already mentioned, VB payments are simply periodic withdrawals from your CSS Pension Plan account. Since your pension funds remain in your account, they need to be invested. The investment fund options available to you are the same ones that are available to you today. The same balance fund, bond fund, equity fund, and money market fund. We will go into more detail about investing your pension funds in retirement for VB payments in the investment choice section that follows, which will be covered by my colleague Fiona May.
Hi, I'm Fiona May, one of the pension plan consultants for the CSS Pension Plan, and I'm going to take you through the rest of this module. The CSS Pension Plan has 4 professionally managed investment funds for its members. These funds are unique to the CSS Pension Plan and are not available anywhere else to the general public. The first fund we will look at is the Balance Fund. The Balance Fund is a moderate risk and moderate return investment portfolio that is very broadly diversified. It is suitable for a long-term investor seeking moderate long-term growth. It is expected to suffer periodic short-term losses or negative returns from time to time. It is a portfolio of about 55% equities and 45% fixed income, real estate, and mortgages. As you can see, it is a very well diversified portfolio of global investments. The Balance Fund is the default option, so unless you instruct or have instructed the pension plan otherwise, this is a fund in which your contributions and your employer contributions are invested. Its management expense ratio, or MER, last year, or in 2020, was 0.43%, which if you have any mutual fund type investments of your own, you'll know is a very favorable MER. The 2020 return was 4.49%, and its 5-year return was 6.21%, and the 10-year return was 6.85%. The money market fund invests entirely in short-term investments. It is a low-risk, low-return investment option, so it is not recommended as a long-term investment. The money market fund MER is 0.14% for 2020. and its anticipated return over the last 10 years has been around 1%. You may want to consider this fund as you approach retirement to protect yourself from a possible negative return if you plan to convert your pension funds into the traditional monthly pension option. Or you can also consider using this fund as a spending reserve if you plan on taking the variable benefit option at retirement. We'll discuss these considerations in a bit more detail later on. Most of you will have been invested in the balance fund for most, if not all, of your careers. This slide shows the difference in the rate of return over the past 10 years for the balance fund and the money market fund. The 10-year annualized return for the balance fund is 6.85%. The balance fund is a very well-diversified portfolio of global equities, real estate investments, exposure to emerging markets, government and corporate bonds. And because of what it's invested in, we fully expect it to see negative returns from time to time. However, over the long term, we expect it to provide the types of returns necessary to build an effective nest egg while members are working, and to continue to provide the long-term growth needed to sustain a viable retirement income. The inherent risk and return relationship of the investments in the balance fund is why we see such a substantial difference in the long-term rates of return between it and the money market fund. The bond fund is suitable for members who are willing and able to accept lower average returns to reduce the risk of short-term losses. Given its lower expected return, the fund may not produce sufficient earnings over the long term to produce an adequate retirement income. Because bond prices tend to decline when there is an expectation for interest rates or inflation to increase, the bond fund can suffer occasional short-term losses. Its management expense ratio for 2020 was 0.31%, and its return in 2020 was 8.1%, which is a great return for a bond fund. However, its 5-year and 10-year returns are more typical over the long term for a bond fund. As you can see that those returns are just over 4%. The bonds, mortgages, and emerging market debt in the bond fund are the same bonds, mortgages, and emerging market debt contained in the balance fund. The equity fund is suitable for members who are willing and able to accept a greater risk of short-term losses in order to have the opportunity to earn higher average returns over the long term. On occasion, equities have been known to produce negative returns beyond the short term. During these times, equities have earned returns lower than fixed income and short-term investments. The management expense ratio for 2020 for the equity fund was 0.46%. The 2020 return in the equity fund was 2.93%, and its 5-year and 10-year returns were 7.78% and 8.52% respectively. The equities in the equity fund are the same equities contained in the balance fund. As you get closer to retirement, there are a number of things you need to consider, such as how much retirement income are you going to need? Do you have enough money saved to provide the retirement income you're going to need? And what type of retirement income are you going to choose? Are you looking at the traditional monthly pension, or are you looking at the variable benefit payments? Depending on which retirement income option you are planning to take, there are different strategies that you should consider regarding how you might restructure your investments as your retirement approaches. Generally speaking, if you are more than 3 to 5 years from retirement, you probably still need more growth in your pension savings, so you should stay invested in the balance fund or some combination of the equity fund and bond fund. If you are less than 3 to 5 years from retirement and you plan to take a traditional monthly pension, then at retirement you will be exiting the markets with your pension funds. In order to protect or preserve your pension funds from a possible negative return before your pension starts, you should consider gradually shifting your pension funds into less risky investments such as the money market and/or the bond fund. You would do this because you wouldn't necessarily have time to recover from a negative return before your pension starts. For example, if you are 3 years from retirement, you might consider transferring a third of your funds from the balance fund into the money market and/or bond fund. Next year, you would transfer over another third, and then 1 year before you start your pension, you would transfer over the final third of your pension funds. Using this strategy, you are averaging out of the investment markets into safer, less risky investments. If you are less than 3 to 5 years from retirement and planning to take the pension plan's variable benefit option, you'll want to stay in the markets with a good portion of your pension funds, as you will still have a long-term investment horizon of 15, 20, 25, or maybe even more years of retirement. You can stay in the markets by investing in the balance fund or some combination of the equity and bond funds. By staying in the markets, you would expect to earn a higher long-term average return and reduce the impacts of inflation. You should also consider investing some of your pension funds in the money market fund for a spending reserve. The CSS Pension Plan suggests having 2 to 3 years of withdrawals in the money market fund, and that you would make your variable benefit withdrawals from the money market fund. Each year, when markets perform well, you would replenish the amount you withdrew from the money market fund from your investment in the markets, such as the balance fund. In the years when the markets don't do well, you would not transfer out of the balance fund to replenish the money market fund. You would still have funds left in the money market fund to pay you your retirement income, which allows you to leave the balance fund alone to let it recover. Once the markets recover, you would then replenish the money market fund by transferring from the balance fund. Let's go through an example of how some members use the money market fund for their spending reserve. Let's say we have a member who has decided they want a spending reserve of 2 years' worth of variable benefit withdrawals in the money market fund, and their retirement plan indicates their withdrawal is going to be $1,000 per month. This member is going to have $24,000 in the money market fund at retirement for their spending reserve. When they retire, they set up their monthly variable benefit withdrawals to come from the money market fund. After a year has gone by, they look at how the balance fund investments have done. If the markets were good and the balance fund had a good return, they would replenish the $12,000 withdrawn from the money market fund by transferring another $12,000 from the balance fund to the money market fund. So they are now back to having 2 years' worth of withdrawals, or $24,000 in the money market fund. Now another year goes by with $1,000 coming out of the money market fund each month. However, this past year the markets were down, and the balance fund had a negative return. There is no need to panic because there is still $12,000 left in the money market fund, or 1 year's worth of retirement income, so they can leave the balance fund alone and let it recover. Using the spending reserve strategy helps to avoid being forced into the situation of having to take money from the balance fund when markets are down. In other words, selling low. Ideally, we want to take money from the balance fund when the markets are up, or sell high. This is not guaranteed to work all the time. It could break down if we had a multi-year downturn where we saw negative market returns for an extended period of time. We suggest that you start establishing your spending reserve when you're 3 to 5 years from retirement by transferring a portion of your pension funds from the balance fund each year into the money market fund, so that when you retire you have your desired 2 to 3 years worth of retirement income in the money market fund. Also, keep in mind that with the variable benefit option, your annual investment returns will fluctuate from year to year, so you should be prepared to adjust your variable benefit withdrawals accordingly. When you are ready to change how your funds are invested in the CSS Pension Plan, please be advised that you can now submit investment instructions online through the My CSS Pen portal at no charge. You can still submit paper-based investment instructions where the first 2 per calendar year are free, but there is a $75 processing fee thereafter. You might want to review your investment instruction decisions with a CSS Pension Plan consultant or a qualified financial advisor to ensure it is consistent with your plans for retirement. More investment choice information can be found on our website. While every investor wants to buy low and sell high, it's easier said than done. If it was easy, we'd all be rich. Moving money in and out of the markets in an attempt to beat the market is called market timing. Stock markets can move without warning and by large amounts in response to unforeseen events. This slide demonstrates the dangers of market timing. It shows that it's time in the markets, not timing the markets, that leads to long-term success. We are going to look at a $10,000 investment in the U.S. S&P 500 stock market index for the 15-year period from December 31st, 2003 to December 31st, 2018. If you were fully invested in the S&P 500 for the entire 15-year period, which includes 2008 when the S&P 500 lost something like 40%, your $10,000 investment would have grown to over $30,000. This translates into an annualized return of 7.8%. However, if you missed only the 10 best trading days of the 15-year period, your $10,000 would only have grown to about $15,500, or a 2.96% annualized return. If you missed the 20 best trading days, you didn't make any money during that 15-year period. If you missed the 30 best trading days, your $10,000 is only going to be worth about $6,800 15 years later. And if you missed the 40 best trading days, your $10,000 is worth less than half as much. It is important to note that these best trading days typically happen just before the market highs and right after the market lows. Since we don't know when these highs and lows are until a number of months after the fact, someone who is trying to time the markets is going to miss some of those best trading days, and that is going to affect their overall return. So again, it's time in the markets, not timing the markets, that leads to long-term success. Let's now have a look at the retirement income options that are available to you outside of the CSS Pension Plan. Registered Retirement Income Funds, or RIFs, and Prescribed Registered Retirement Income Funds, or PRIFs, are very similar to the variable benefit option from the CSS Pension Plan, except these retirement income vehicles are available from credit unions and other financial institutions. As already mentioned, RIFs and PRIFs are retirement income vehicles available from credit unions and other financial institutions. The PRIF is for locked-in funds subject to Saskatchewan pension legislation. Like variable benefit payments from the CSS Pension Plan, with RIFs and PRIFs you are not guaranteed to receive an income for life. You get to set the payments, and you are responsible for investment decisions. In accordance with the Income Tax Act, you must make annual minimum withdrawals from your RIFs and PRIFs, which start the year after you set up your RIF or PRIF account. Each year that you get older, the minimum percentage that must be withdrawn increases. If you do have a spouse and he or she is younger than you, you can have the minimum based on your spouse's age, which would then make the minimum withdrawal less than if it was based on your own age. If you recall from the variable benefit section, the minimum for variable benefit payments doesn't start until the year you turn age 72. Like variable benefit payments, there is no maximum payment, so you can set your payments or withdrawals to be whatever you want. You can also stop or turn off the payments up until the end of the year you turn age 71. And again, like variable benefit payments, you can change the amount of your RIF and PRIF payments. Like variable benefit payments, whatever money is left in your RIF or PRIF account when you pass away will go to your heirs. With the RIF, if you have a spouse as defined by the Canada Revenue Agency, and if he or she is named the successor annuitant, then it is a tax-sheltered rollover to your surviving spouse upon your death. If you don't have a successor annuitant, then it's a taxable lump sum to your named beneficiaries or estate upon your death. However, please keep in mind that it doesn't matter who gets the remaining funds. The estate pays the income tax on the remaining funds even if the funds go to named beneficiaries. So this may require some special estate planning to ensure the estate has sufficient funds to pay this income tax. With the PRIF, if you have a spouse as defined by Saskatchewan pension legislation, he or she must be the beneficiary unless they sign a waiver form. Like the RIF, it would be a tax-sheltered rollover to your surviving spouse upon your death. If there is no spouse or your spouse signs the waiver form, then it's a taxable lump sum to your named beneficiaries or estate. Again, it doesn't matter if the named beneficiaries or estate gets the remaining funds, the estate must pay the income tax. This is different from variable benefit payments that you would receive from the CSS Pension Plan. With variable benefit payments, if the named beneficiaries get the remaining funds, they pay the income tax. The estate pays the income tax only if the estate gets the remaining funds, so estate planning is somewhat less complicated with VB payments from the CSS Pension Plan. There is a wide range of investment options for your RIF or PRIF. The investment options are basically whatever is available through the credit union or other financial institution you are dealing with. They can range from GICs and term deposits to mutual funds and self-directed plans. If you're investing in mutual funds or self-directed plans, please be sure to discuss with the credit union or other financial institution what you will be paying for investment management fees. We suggest you compare those fees with the management expense ratios or MERs of the CSS Pension Plan's investment funds before you make the final decision to transfer your funds over to a RIF or PRIF. Generally, the implications for RIFs and PRIFs are the same as the implications for variable benefit payments. You have a lot of flexibility in setting your retirement income, but if you don't exercise self-discipline or you set your payments too high, or if your investments don't perform as expected, you could easily and unintentionally outlive your pension funds. This is the end of Module 3. We have now concluded all 3 legs of Canada's 3-legged retirement income stool. At your convenience, we suggest you view Module 4 entitled Choosing, which outlines some things we feel you should consider in making some of the choices leading up to your retirement. Also, if you are considering variable benefit payments from the CSS Pension Plan or a PRIF and or RIF from a credit union or other financial institution as a retirement income option, we strongly suggest you also view the module entitled Uncertainty of Returns Risk. This module helps to explain how the risk or uncertainty of not knowing what will be the rate of return on your investments can impact how long your pension funds might last in retirement if you don't adjust your payments when the rate of return is less than expected. In other words, this module helps demonstrate that VB payments as well as PRIFs and or RIFs are not the type of retirement income option that you can set up and forget about. You have to keep an eye on them during your retirement. As is always the case, if you have any questions, please do not hesitate to get in touch with us. We're here to help you make an informed decision.